The investment banking technical interview, it's really the final gatekeeper, isn't it? It's this high-pressure test of how well you understand value, valuation, and financial modeling. It's designed to see one thing: do you truly speak the language of finance? But here's the secret, okay? It's not about memorizing dozens of formulas. Not at all. It's about understanding the core logic that connects everything together. And in this explainer, we're going to give you the frameworks you need to confidently tackle pretty much any technical question Wall Street can throw at you. We've broken it all down into 4 key areas. First, we're going to cover the basic language of value. Then we'll build out your valuation toolkit. From there, we'll see how those tools are used to model the biggest deals. And finally, we'll get into mastering those nitty-gritty technicals that really test your attention to detail. Let's dive in. Okay, let's start with the absolute foundation. I mean, what do we even mean when we talk about a company's value? Turns out there are 2 critical answers to that question, and you absolutely need to know the difference between them. So on one hand, you've got enterprise value, and on the other, equity value. The best way to think about it is like a pie. Enterprise value is the entire pie, the value of the whole business that belongs to everyone with a claim on it, both the lenders and the owners. Equity value, which you probably already know as market cap, is just the slice of that pie that's left over for the shareholders. So, and this is the crucial part, enterprise value is basically the takeover price, right? If you wanted to buy the entire company, you wouldn't just be buying its stock, you'd also have to take on its debt. That's exactly why the formula adds debt and then subtracts out any cash the company has on hand. And what's left over? Well, that's the equity value. It's the part that the owners, the shareholders, can truly call their own. It's the number you see quoted all over the news every day. Just getting this one difference down is the essential first step. All right, so now that we get what value is, how do we actually go about calculating it? This brings us to the analyst's toolkit. And inside that kit, there are 3 essential valuation methods you've got to know. You know, you can think of it like appraising a house. First, you've got comps. This is where you look at what similar public companies are worth right now. It's kind of like checking the asking price for other houses on your block. Second, you have precedent transactions. Here, you're looking at what similar companies were actually bought for in the past. This is like looking at the final sale prices, which often include a nice little premium. And third, you have the DCF, which calculates a company's intrinsic value based on its future cash flows. That's like figuring out the house's value based on all the rent you could collect from it over the next 30 years. Now, of those 3, the discounted cash flow, or DCF, is the most fundamental. It's the one they really love to ask about in interviews because it gets to the heart of a company's ability to just generate cash. So yeah, let's zoom in on that. Building a DCF can sound really complex, but honestly, it all boils down to a 5-step process. You project a company's cash flow out into the future, you estimate what it's worth at the very end of that period, that's called the terminal value, and then you discount all of that future money back to what it's worth today using a special rate called the WACC. So that discount rate, the WACC, stands for the weighted average cost of capital. It's just a fancy way of saying it's the blended cost of all the money a company uses, whether it's debt or equity. You figure out the cost of equity using a formula called CAP, AM, you find the after-tax cost of their debt, and then you just blend them together. This final rate is the hurdle that any project has to clear to actually create value. Okay, so we've got the theory down. Now for the fun part. Let's look at how all this is applied in the real world with 2 of the most important models in finance, the leverage buyout, or LBO, and the good old merger model. First up, the LBO. This is the absolute signature move of private equity firms. The core idea is actually pretty simple. You buy a company using just a little bit of your own money and a whole lot of borrowed money. That's the leverage part. I mean, look at a typical LBO. The private equity firm might only put up 30% of the cash themselves. The other 70%? That's all financed with debt. The whole game is to then use the company's own cash flows to pay down that debt over time, which dramatically juices the return on their original investment when it's time to sell. So how do they make money doing this? Well, it really comes down to 3 main drivers. First, you can actually improve the company's operations to grow its profits. That's EBITDA. Second, you can get lucky with multiple expansion, which just means you sell the company for a higher valuation multiple than you paid. And third, and this is what's really unique to an LBO, is just using the company's cash to pay down debt, which directly, dollar for dollar, increases the equity value. All right, let's switch gears. We're moving from buying a company with debt to buying a company with another company. This is where the merger model comes in, and it's all designed to answer one single crucial question. And that question is, will this deal make our shareholders better off on a per-share basis?
The metric we use for this is earnings per share, or EPS. If the new combined company's EPS is higher than the acquirer's was before the deal, we call that deal accretive. That's a good sign. If it's lower, the deal is dilutive, and that's a potential red flag.
All right, buckle up for our final section. We're going into the lightning round. These are the tricky accounting questions that really test whether you get how money actually flows through a company's veins. Here is a question you are almost guaranteed to hear in one form or another. Let's say a company uses $100 in cash to buy $100 of inventory. Walk me through what happens to the three financial statements: the income statement, the cash flow statement, and the balance sheet. Okay, let's walk through it. First, the income statement. Anything happen? Nope, no change at all. You haven't sold the inventory, so it's not an expense yet. Second, the cash flow statement. Well, you used cash, so cash flow from operations goes down by $100. Simple enough. Finally, the balance sheet. It has to stay in balance, right? So cash goes down by $100, but inventory, which is also an asset, goes up by $100. The asset side just swapped one asset for another. The total stays the same. Now, it's super important to remember that this standard playbook doesn't work for every single company. You've got certain industries, like banks, for example, that operate on a completely different model, and you have to value them differently. A DCF, for instance, just doesn't really work for a bank. You see, for a bank, the business is the balance sheet. So instead of focusing on cash flow, we focus on metrics like price to book value. And to see how profitable they are, we use ratios like return on equity to see how well they use their capital, and net interest margin, which is basically the spread between what they earn on loans and what they pay out on deposits. And all of this brings us to a really crucial final point, and it's captured perfectly in this quote from the valuation guru Aswath Damodaran. All these models and formulas we've talked about, they're just tools. Knowing how to build them is step one. The real skill, the craft, is knowing which tool to use, how to interpret the results, and how to tell the story behind the numbers. Which leaves us with one last question. After all the spreadsheets are closed and the calculations are done, what are you actually measuring? The numbers are just a reflection of the business itself, its strategy, its competitive advantages, the quality of its leaders, its ability to innovate. That's what you're really trying to solve for, and that is the code you need to crack.